So the second half, or second part, it's not half, we're going to keep this fairly short, is how to conduct an estate planning checkup. So I want to give you something each session that's not technical as much as it is, what I do when I'm doing an estate planning checkup with clients. Every 2 years after we finish an estate plan with a client, we close the file because our ethics dictate that we're required to do that, unless we want to keep the file open and then be subject to potential malpractice liability for anything that happens in the interim. So we close the file, we send the client a letter saying we closed your file, terminated the engagement, but we're going to keep in touch with you, or we'd like to keep in touch with you in the future so that we can educate you and make sure that you continue as our client. And so what I try to get my clients to subscribe to my blog. The blog has served a really good purpose in that regard. It's not just a marketing tool, it's an educational tool that I use to bring information to all the clients. Anytime there's a development in tax or estate planning or business planning, I try to post something to the blog, whether it's a podcast or it's a blog article or taking them to another article, keeping them up to speed on what's happening in the world of tax, estate planning, and business planning. And if they subscribe, they'll get a notification. If they don't subscribe, they won't. But every 2 years, we'll send out a letter to our clients that after every file is closed, and we do it pretty much quarterly, on a quarterly basis, and let them know that it's been 2 years since we finished your estate planning documents. Would you like to come in for a checkup? And that's been great for us in terms of not only recurring revenue, but keeping us in front of our clients. And our clients really, I think, have taken great advantage of that. Some of our advisors that we work with who are representing high net worth clients, 10.9 million and up, let's say, and we have a lot of those, will meet with us at least annually, if not more, because they've got a lot of stuff going on. So the financial advisors and us are always in touch with each other, and we're always talking to each other about LLCs and trusts and other things that we're doing for them. But in the case of the regular client who doesn't have that much wealth, they still may need updates. And so that's what we're going to talk about today, the importance of keeping the estate plan current. I've had clients come back to me after 10 or 15 years. I've had new clients come in the door who hadn't done anything for 15 or 20 years. That's not really good planning on their part, but we can't force our clients to do this. So this gives us an opportunity to get in front of our clients, to help them achieve their goals and objectives, and also gather more assets under management, help them do things that might enhance your practice as well, charge fees for financial planning or whatever. So let's talk about a model estate plan today too. We'll go through a series of questions that we typically ask that you have in your handout. You can use as you need it. In the last session, we gave a handout that also has some very good questions to ask your clients, not only for estate planning in general, but estate planning checkups. And so we want you to have confidence to talk to your clients about their existing estate planning. Hopefully these sessions will give you that confidence. By the end of session 6, you're going to be an expert. So why is it important? Well, if we don't check our estate plans for our clients, if we don't check the beneficiary designations of the IRAs and the 401ks, if we don't check how the assets flow upon death, then we may have unintended beneficiaries. We may have bad choices of who's running the estate in terms of who the trustee is after someone passes away or their agent for their power of attorney. We may have healthcare instructions that don't represent their current goals and objectives, and it may result in higher costs and delays in administering this as well as taxes, because a lot of our clients, even though the exemptions have gone up, so have their estates. And so we've got a lot of clients, hundreds of clients, that are in a taxable estate situation. Now that's not just $10.9 million. In the District of Columbia, what's the exemption? Anyone? $1 million per person. So for a married couple, it's $2 million. The DC Council did pass legislation that would increase it to the federal exemption, which is 5.45, but Congress hasn't let them go forward with it because of their liberalization of marijuana. That's exactly the reason. So the Republican Congress has kept the DC exemptions at 1 per person. In Maryland, it's being phased up to the federal exemption. And so we still could have an estate tax even if the estate is not in excess of the federal exemption. In New Jersey, the exemption is $600,000. So again, you've got to know your clients. Where they reside is going to determine where the estate tax is imposed. And these state death tax rates can be up to 16%. There's also inheritance tax in Maryland and New Jersey and Connecticut and other states. And so you have to be careful of that for clients who reside in those states. So understanding there are 3 constants that aren't constant. There are 3 things that are constantly changing that we have to be aware of. And if any of these 3 things change, we may have to update the estate plan for that. Number 1, changes in your family. 2, changes in your finances. You have a client that had a closely held business, they sell it for $20 million, all of a sudden they're in a taxable estate situation. What do we do? And then the laws. Hey, I'm a tax lawyer, I always will be. I'll never be without a job. It's not a very good commentary on our society, because with each change in administration and each change in the Congress, there come changes in the tax laws. I've been doing this since 1980, and every year there's some major change that we have to take advantage of or watch out for our clients. And so it'll keep me in business for the rest of my life, regardless of whether they repeal the estate tax if Trump gets elected, or they increase the rates and decrease the exemptions if the Democrats take over. Who knows what's going to happen? I'm not going to predict it. Anybody in here want to predict what's going to happen in the election? So the changes in personal lives, in detail. Child gets married, their name changes, they have children. Somebody gets divorced. If you have a client that has been divorced or gets divorced, that requires a change to all their documents at a minimum. We've had clients who've come in, husband and wife, where we will represent the 2 of them. There's a waiver of conflict that they have to sign at the beginning of the engagement, because we're representing 2 people who may be adverse at some point in time in the future. And so if they do get divorced, we cannot represent either unless both consent to it later on. So there's an ethical set of rules that attorneys are bound by. Some attorneys follow it very closely, others don't. But the idea is that changes happen. And so we have to make sure that we're accounting for the changes in our client's situation. Their health may change. It may require more planning in the case of incapacity. The trust may not be sufficient. It may not talk about incapacity. Or if all they have is a will, there is no real planning for incapacity, because powers of attorney do not work. In many cases, financial institutions have trouble with T/E. They have more trouble with powers of attorney that are drafted by about 80% of all the attorneys around the area. So our powers of attorney, if you've looked at them, are 20 pages long. Why? Because we've been through this rigmarole with all the banks and the financial institutions. We know what to expect. So, and then their goals, their values, their legacy may change over time. Financially, they may inherit some money. One spouse may inherit it. She may want to make sure that those assets go to her kids exclusively, not to her surviving spouse. Other inheritances might be made available through a trust, but that's regulated so that the surviving spouse just can't pull it out and give it to a new spouse. You retire, that changes everything, right? Sale of your business, new job, stock market volatility. Who's not talking about that this year? In the estate planning area, of course, the estate tax, the income tax, those 2 areas will constantly change. But then there's also asset protection, and the DOMA is the law that refers to how same-sex couples are treated. We know to a very great degree, for tax purposes, they're all treated the same now if they're married. They have to be married in order to get that benefit. And the question is, how far does it apply to employee benefits, to fringe benefits, insurance, and property ownership? So how do you conduct an estate planning checkup? Here's some questions that'll help you do that. Use these questions. Ask them of your clients when you sit down with them. They don't have to be with an estate planning attorney. You can do this. And if you sense that there's any uncertainty about these questions as you go through with it, then you need to maybe refer them to their estate planning lawyer so that they can take care of the things that they would not have otherwise taken care of had you not answered. Ask this question: does your current healthcare power of attorney permit the person that you want to make emergency healthcare decisions? If they say yes, absolutely. I know exactly who I've named. I know exactly who I've. You should look at the document with them. They're going to say, well, you're not a lawyer. It doesn't matter. You can read. You're smart. And we'll show you how to do it. If you have questions about it, call us. We'll answer the question for you. There's no charge. That's why I deal with all of you. You call me, I answer your questions, and then if I can help you, great. Second question: does your estate plan contain a customized plan to determine if you are mentally disabled? Incapacity under the terms of the trust or the power of attorney or the healthcare power. What does that mean? How is it typically defined? If you just say, well, one doctor determines that you're incapacitated, which is like what we were talking about on the advanced medical directive, then that may not be what you want. You could say two licensed physicians, one of whom is your attending physician, have to make that determination. That may not be what you want. You may want your family members involved. You may want your spouse involved in that decision. Then you're expanding it from two physicians to a panel of people. Or you may not trust your spouse to make the right decision. I've had clients tell me that as well. Usually the minority of clients, but still, I don't want her making that, I don't want him making that decision. He'll put me in the home immediately. He'll take over the assets. So it's a question that needs to be addressed in every estate plan and should be talked about in detail. Most clients have a good idea of what they want, but you've got to expose them to the flip side, the downside of what, having one doctor name, be able to name you as incapacitated might result in. So that's question number 2. Question number 3, what happens if you're disabled under your estate plan? Well, let's say you've got a power of attorney, and that's it. You've got a will, a power of attorney, a healthcare directive, and that's the standard basic estate plan that most people have, if they have one. Is that enough? Will a power of attorney, a general power of attorney, allow your agent to make decisions about real estate that you and your spouse own together, or that you own? What did I say earlier? The answer is no. Title companies will not allow that to happen. What will happen is that you have to go to court, which costs a minimum of $5,000, and who wants to spend that kind of money on that? So why not have, again, a revocable trust that has provisions in it dealing with incapacity? For our elder clients, we have an expanded set of incapacity provisions where it really gets into details about the care that you want to have if you become incapacitated. Do you want a care manager? What must that care manager be doing with you over that period of incapacity? Do you want not only yourself to be taken care of during the period of incapacity, but also your spouse, so that they can get access to the assets to take care of themselves? What about dependents, children, or parents? These are all things that should be talked about. What about gifting during incapacity? Let's say you make birthday gifts every year of $1,000 or $100 to your kids, and you become incapacitated. If your trust or your power of attorney doesn't have language in it to allow that to continue, they can't. They're not supposed to do that. So include this type of language in your incapacity provisions, in your documents, and if they don't have it, advise them to get something that allows them to do that. Christina?